Good afternoon, and welcome to this afternoon's DBE Business Accounting Training for Construction. This is Victoria Beal with the LTAP Center, and I want to thank you for joining this session that's being supported by the ODOT Office of Diversity, Inclusion, Supportive Services section, which Micah Flanagan heads up. We have for you this afternoon two excellent presenters and subject matter experts in this area, Laurice Purnell and Meltrice Sharp, who will be making the presentation this afternoon, and I know that they will be engaging you in lots of conversation. So get ready to unmute yourself and participate and ask questions. As a part of that, I do want you to look for the question box in the GoToWebinar panel, and if you would please drop me a hi or hello in there just so I know you found it. That's how we're going to be asking you to pose questions throughout the entire presentation. In addition to the sections where we unmute everybody and ask you to ask audio questions or engage in that way. Also, in our handout section of the GoToWebinar panel, we have for you a copy of today's presentation along with our Ohio LTAP e-learning catalog. And I would encourage you to download this catalog. And when you have some time, take a look at it, because we have available for you over 300 different courses that you can take via our e-learning platform. These courses are available for you at no cost because we have worked hard to get them funded through federal grant money to get them created. And there are courses in there that if you are interested in getting into new areas to do work for ODOT, that the pre-qualification can be taken completely through the e-learning. So I definitely encourage you to take a look at that. There's also a great series of frontline worker courses that your frontline workers can definitely benefit from, and you can use for training plans and development plans for your staff that we have worked with AASHTO to create as well. And it's a compilation of all 50 state DOTs who've worked together to put those AASHTO TC3 courses together. And there's over 200 of those alone in the catalog. So with that, I'm going to turn things over to your presenters. So Meltrice, it's all yours.
All right, good afternoon, everyone, and thank you for joining us today. We know that this is your busy season, so taking the time out today means that you're really excited about investing in yourself and in your business. My name is Meltrice Sharp. As Victoria mentioned, I am managing partner of CLE Consulting Firm. I started my career at an accounting firm called Ernst & Young. Many of you should be familiar with that. As an auditor, during that time, I did get an opportunity to work with large construction companies, and which is where I got my roots. I then left there and worked for a company that used to be known as Forest City Enterprises. They were recently sold, but they were a national real estate company that owned, developed, and acquired real estate across the nation. There I served in a variety of financial analyst roles, financial manager roles. I started the supplier diversity program, which is where I noticed that there was a lack of financial education for small businesses. This lack of education or lack of knowledge in this area really prohibited them from being able to grow and scale. When I decided to leave Forest City, I decided to start a business helping small businesses, particularly underserved small businesses in this area. I wanted to change the financial landscape of the small businesses, and that's when I met my wonderful partner, Laurice Purnell. There's a long, funny story around that I won't share right now, but we met, we realized very quickly that we had a shared mission and vision and a commitment to the community to work with small businesses that are underserved, that really don't know the importance of their financial infrastructure. And with that said, we started the business 4 years ago. The rest is history. We tell people that CLE is a new, I would say new accounting firm, in that it's only 4 years, but we are not new in the industry. We both have over 20 years of experience, which is why we can share with you the do's and the don'ts, and hopefully we can present this information in a way that's digestible, because I realize that this topic is very technical. It's very dry and boring and tough sometimes. A lot of people come to us and say, look, I don't do this very well. I just want you to do it. but it's really important that you hire someone who does it well, but you also know it enough that you can manage that person appropriately and effectively, and that you can really take the information that they're sharing with you, use it to scale your business and evolve and grow your business. So I'm just happy to be with you today. We do want to make this a very interactive and engaged conversation. So we'll be asking questions and throughout, and hopefully you will engage with us. And then we'll also have some time for Q&A at the end, where we can hopefully address some of your questions and concerns. But without further ado, I am going to give my partner an opportunity to introduce himself.
Hello, everyone. I would echo everything that my amazing business partner had to say about, the organization we started in CLE. I'm a native of Cleveland, went away to University of Toledo, Bowling Green, and University of Toledo, worked as a financial analyst, and then got into the nonprofit arena before meeting Meltrice about 4 years ago, and started in CLE. I sit on, civically, I'm very engaged. I sit on multiple boards here as a treasurer throughout Northeastern Ohio, and continue just to spend a lot of our time to helping small businesses, like Meltrice mentioned, to ensure that they have the proper structures to be able to compete in this competitive market and have all the tools necessary to elevate from just being businesses to being enterprises right here in our city. So we are elated, and I'm excited to share some amazing information with you today. Please be engaged, ask questions. We are here to serve you today and make sure that you leave better than you came. So we look forward to this conversation today.
Absolutely, absolutely. Thank you. Victoria, if you don't mind helping, we do want to scan the crowd a little bit. Unfortunately, we can't see you, which is really sad for me today. I love to see the audience, but we can't see you. But we do want to maybe a few of you can tell us, why did you join this session? Why did you think this was an important session? And what do you want to take away from this session today? Can we get a few answers on that?
Okay, I am running down and unmuting everybody
Okay.
because there isn't hundreds of you on here, which that's a good thing. So I'll tell you in a second here once I've got everybody unmuted, and then hopefully you can just unmute yourself on your end and then respond to the question that's been asked. So, all right, looks like I've got everybody unmuted on my end, except Kendra. I had to send you a pin. So if you would like to respond to the question, you can unmute yourself and go ahead and respond. Okay, we don't want to hear crickets out there, guys.
No
Hello.
responses.
Come on, it's
Hello.
supposed to be interactive. How can we throw virtual candy? Oh, hey, there we go. Hi, Steve.
Hi.
Steve.
My name is Steve Henderson. I'm with the city of Canton. I am a construction manager, and I simply want to get a better handle on the accounting that the consultants and contractors use, simply to see it from my point of view. I'm wanting to go on for PMP, but I think this might help me out some, just to get the nomenclature.
Great. Thank you, Steve.
Sure.
Any others? Don't be shy. One more. Okay, maybe not. Well, let's not belabor what we're trying to accomplish here. I am trying to advance the slide. Okay, Victoria, am I able to do that? All right, so today topics, we're going to cover profit and loss, which is synonymous with an income statement. So sometimes you'll hear P&L, sometimes you'll hear profit and loss, sometimes you'll hear income statement, all the same thing. We'll talk about all of the components on that and share a little bit more about what that statement shows you. We'll talk about your balance sheet, which is your statement of worth, for lack of a better word. We'll talk about that. We'll talk about some important construction ratios and accounting ratios, your cash flow statement, and really how to effectively manage cash flow. We know that in the construction industry, if you don't effectively manage your cash flow, that could be the end of your business. So we'll give you some tips and tricks about how to effectively manage your cash flow. We're going to talk very quickly about some sources and uses of your funds, net worth, and hiring an accountant. What are some important things about that? And what are some other important things that we think are important as you're considering hiring an accountant? And then we'll open it up for Q&A. The course objectives for this is understanding the profit and loss statement and key considerations for construction companies when analyzing a profit and loss statement. Same thing with balance sheet, understanding that. What are the key considerations? And as a construction company, how do I analyze it? Understanding common ratios used in the construction industry and how to really leverage these ratios to make business decisions. Understanding the cash flow statement and the importance of cash flows, understanding sources and uses, and key considerations, and understanding what your construction company is worth. Really, really important in this day of mergers and acquisitions. What am I worth? And then key things to consider when choosing an accountant. So those are the objectives for today's session. And again, if we do not hit on something that you're interested in during the Q&A session, feel free to ask questions and hopefully we'll answer them. If we can't answer them, we'll jot them down and get answers back out to Victoria and team, and she can share those answers with you guys later. So without further ado, I will pass it on to Larice to talk about profit and loss and income statement.
Okay, so again, we would like to welcome everybody to this session today. And so
Did your PowerPoint freeze up there? Go ahead and try your forward and back keys. There you go. You got it.
So we're going to jump right in. And when we're usually in person, I'll tell people looking at me is not the best thing. Let's make sure that we're stroking those pens so we know that work is getting done. So I can't see you, so I'm going to trust that we'll all take great notes today so we can leave with some great information. So again, we'll jump in like one of our partners talked about, the profit and loss and income statement. Of course, also known as the income statement, our statement of operations, statement of earnings. So it has a couple few names out in the market that you may hear. Now, this statement particularly focuses on your revenues, expenses, gains, and loss, and truly is the report card of the company. It's not a cash flow statement. It's one of three important statements that you will use to evaluate your business, that being your profit and loss, your balance sheet, and your cash flow statement. So typically it's broken down over, by month, quarter to date, year to date, and we'll kind of talk about even that more in depth to say, what is really typical and what is necessary to ensure efficiency within your business. Now, when you're writing up a profit and loss statement, as you can see, this is an example. Some things that you want to consider is how do you write a profit and loss or create a P&L statement? One, you want to track your expenses, determine your cost of sales, figure out your gross profit, add up your overhead. You want to calculate your operating income, and then adjust any other income or expenses. And then, of course, the most common thing is we want to look at the bottom line, which is our net profit. And we hope that because you're utilizing your financial statements and in creating efficiencies and looking on a regular basis, that you're going to have a net profit and not a net loss as a business. So again, as you can see, we have this example laid out. It shows you the monthly being December. Then we have our quarterly to date, and then we have our year to date. And of course, as a business, in order to create success as well, we want to make sure that we're analyzing that against a budget. And being in this industry, we want to make sure that we're budgeting per the project to ensure that we're making sure that we're running a profitable project and a profitable organization. So again, you see in here, you have your construction revenues and then your costs, and which gives you your total income, and then your construction costs being your different material, labor, subcontractors, equipment, therefore giving you that construction cost. And then when we add that, we're going to get our gross profit, which is, in this example, you see there's a negative $50,000. So again, this shows you the importance of making sure that you analyze those costs. Then our overhead being our rent, depreciation, repairs, equipment costs, fuel, and other expenses that you have to ensure that those are being tracked and one accounted for. It gives you then your total overhead costs. Then it provides what your profit is before taxes. Then we have to put income taxes in there that will give you your profit after taxes. So now we're going to continue to go through this, and it just shows you now if you put your budget in there, then you're able to analyze where are you at to budget. So are you over what you projected from a total income? Did you project $1 million and now you're at 1.5 million, which gives you a variance of 500,000. So again, if you're looking at this on a monthly basis or quarterly, it's going to allow you to be proactive versus reactive. And that's the key thing when we talk about any introduction or any importance of making sure that you have profit and loss, balance sheet, your cash flow statement, because you want to know, it gives you a snapshot in time where you are as an organization and what's necessary to ensure success of your business. So why is this important to you? Again, it's an indication of profit. It is timely reporting for your organization, and it's a classification of your expenses and your revenues. And that's important because, one, you want to make sure that you're not overspending in your materials. You're able to see variances. So if you projected that you would have, for example, here, $200,000 in materials, but now you're showing 285, and you have a variance of 85,000. Why is that? Was that lack of overspending? Was it lack of accounting for those expenses? So what is that going to do to that particular project from a profitability perspective? So again, that's the importance of making sure that profit and loss and that income statement is in place for you. So I want to go into now the balance sheet. Notrice, would you want to add something to that profit and loss conversation before I jump into the balance sheet?
You know what I do, Laurice, thank you for asking. I do want to add that, it's really important to pay attention to those percentages as well, because that is going to help you determine how to redirect your energy and your efforts. And it's also really important that you create a similar, more short version of this profit and loss for every project. So what we're sharing with you here is a comprehensive P&L for your business, but it's important that you are profitable per each project. So you want to monitor and manage that for every project as frequently as possible, so that you can ensure that you are not overspending, that you are collecting your revenue timely, and that you're managing that project cash flow effectively. And this profit and loss is a key statement to ensuring that you're doing that correctly. But back to the percentages as well, like if you're budgeting those percentages based on what your estimated costs are, what your estimated profit margins are, and you're not meeting those, then that's where you really need to stop, redirect how you're spending, what you're doing, who you're using for vendors and different things like that. So if you use this financial statement properly, it can show you a lot where you're overspending with vendors, where you may be, your payroll may be higher, so people are sending in more hours or spending a longer time than estimated on a project. So it can really unveil a lot of issues if you're managing it and monitoring it frequently.
Thank you. So what we'll do is let's jump into the balance sheet when we talk about the three important financial statements that we have as an organization, balance sheet being the next one. So a simple balance sheet, the structure being total assets plus your total liabilities and also your total shareholders, shareholders equity as well. So again, assets equals liabilities plus owner's equity is the equation for a balance sheet. So as you can see here, and don't hesitate if you would like, take screenshots of with your camera phone or whatever, and take shots of that so you can have this information at a later date as well. So a balance sheet, snapshot in time. It's your assets and liabilities and equity, which we just discussed as well. So your assets equal your liabilities plus your owner's equity. Your capital structure and your WIP is included on the balance sheet as well, which we'll talk a little more about as we go on. So again, balance sheet. This is a financial statement that reports a company's assets and liabilities and again, shareholders equity. It's one of the three statements as we discussed that are imperative because as you can see, when it breaks down your current assets, it tells you your cash balances within any accounts that you may have. It gives you also your accounts receivable, which in this industry is going to be important. So as you're financing a project, a lot of times you're going to be spending your cash, and then what you're going to do is put out your accounts receivable or invoice that particular client, and then your collectability will dictate how it affects your cash. So the balance sheet is a snapshot, again, representing this the state of the company's finances. It's what you own versus what you owe as well. So as we go through that, as you can see, we break down your bank reserve. We talk about, again, your accounts receivable being what you've invoiced out to those particular clients, and you're holding those debts until those are paid and the cash is received to the organization. And then for your property, plant, and equipment, this is another part of your assets. So if you're holding land, if you have a building that you have within your organization that's owned by your organization, you're going to account for that as an asset. So again, you have your cash account, you have your accounts receivable, and then you have any land, building, and accumulated depreciation for that particular, I would say, property or land that you have. If you have any equipment, that's very important that you give the value and that you account for any assets you have, because this tells you the value of the company. When you're going to a financial organization or a financial institution to get access to capital, they're going to evaluate your balance sheet. In a lot of cases, they're going to lend against what's on your balance sheet. So the first thing they're going to look at is if you own a construction company and you have no equipment, then how are you doing the work? So that becomes a red flag to that organization that, hey, they're running a construction company, and you may be at varying areas where you may not have cranes, you may not have forklifts, you may not have vehicles, you may not have jackhammers or other equipment that may have value to it. But if you do, you want to make sure that that stuff is accounted for, because a lot of institutions is going to lend based on your assets that you have on your balance sheet. So this, from a funding and a growth perspective, is a very important financial statement. So we want to go down into your liabilities.
Maurice, before you go to that, how many people, how many of our clients or prospective clients come to the office and they have not built out a balance sheet, they have not taken any inventory on their assets or anything like that?
So I would say probably more than half of the individuals that come. We have clients that are not even in the industry. They come, and how do you have a restaurant and you have no equipment on there? So what are you cooking on? So that's the thing. When we talk about red flags from a financial institution perspective, when they're looking at an industry, it's some things that there's an expectation that you have, unless you're a startup, they have that you would have in order to do the functions of your industry. So again, are you driving to that particular project? So do you have vehicles? How are you carrying the equipment? Again, the equipment that you do have, all that has to be accounted for because they have different ratios that they use to lend against assets that are on your books. So again, like Mel Tree said, this is a common thing. Most balance sheets that we see always account for the cash, their bank accounts or their cash accounts. So they always are going to have that on there in most cases when they come through our doors. But in very few instances will they actually have their actual property, plant, and equipment laid out for us. And again, and even from a tax perspective, not to dive too deep into that, depreciation is something that you want to make sure that's being accounted for. Because if you have that equipment and you're not accounting for depreciation, that is what they call a non-cash item that they will back that back into your profitability from a lending perspective. So depreciation is something they expect to see on your balance sheet and your profit and loss when you have equipment in place as a construction company. So
And many
when we
small
talk
businesses are, no, go ahead. No, go ahead. I'll
go
talk
ahead.
about it later. I was going to say
Okay.
many small businesses really operate a bank statement business, a bank business. They don't even consider a balance sheet, don't have a balance sheet. All they really have is a profit and loss, and they really only generate that in order to prepare their taxes. So balance sheet is as critical as a profit and loss statement, especially as it relates to being bankable. Yes,
and I'll say it is probably, and maybe I'm biased. I always call us the balance sheet firm. We spend a lot of time working with our clients on balance sheets because as we get further into the conversation, it's going to talk about valuation. How you value a business will be, your balance sheet is going to play a big part as well as your cash flow statement. So again, if you don't have those assets and we talk about valuing that business, well, we want to value it further than what the net profit on your profit and loss is, but we also want to value it based on the assets. So if you're going to merge or you're going to sell the business, well, a person wants to know what they're purchasing. Are they purchasing 5 trucks? Will they get 4 buildings? Will they have, is there an office, building that's owned by the company? How much cash does the business actually have on hand compared to what is being shown between the owner's equity as well as the net profit? So those are things that, we want to make sure that there's accuracy. So in the past, if you have only paid attention to the profit and loss, the balance sheet is imperative to your growth because again, as you continue to elevate your business and you want to grow, banks are going to look at that balance sheet. They're not going to be okay with the profit and loss only. So you're going to want to consider and account for everything because it affects your taxes as well. I want to reiterate that comment. So again, let's break it down again. Items included before we finish up with the balance sheet. Your assets. Remember, that's your cash and cash equivalents and your accounts receivable. So your cash equivalents are your liquid assets. And then your accounts receivable are the amount of money owed to the company by your customers because of a sale of a product or a service. And then your inventory. So those are your assets. Do you have inventory? Are you even accounting for your inventory? So before, when we talk about the budget on the profit and loss, we go back to that. When we see that we've spent more in material, are we accounting for our inventory? Do we know what we have on hand to avoid over expensing from a material or other inventory perspective? So again, accounting for that inventory, that's something a lot of times we don't see. People have a warehouse full of lumber, full of concrete, full of other, equipment that's needed, and they catch themselves going out and spending money continuously on the same equipment because they're not keeping up on their inventory, not understanding that's an asset that brings value. If I buy your company today and I know we're going to do a project on, a property that is, I would say a 4-suiter, and I know I'm going to have to redo all the drywall. Well, if you already have drywall in place and I'm purchasing this company, well, I know that's an expense I'm not going to have to cover, and that's an asset to the purchase of that actual company. So then your liabilities includes, again, as you see here, your current liabilities, including long-term debt, wages payable, and dividends payable. So we see on here, we have accounts payable, which is dollars that you owe out to the organization. We have our wages payables, our interest payables on debt, tax payable, to make sure we're accounting for the tax that we have. If it's property taxes that we have, do we have outstanding taxes for the organization from prior filings? Is that being accounted? Because that's a liability. Someone purchasing the company, or even if you're going to get access to capital, they want to make sure that when they're lending you dollars, that they've accounted for all liabilities, that it doesn't arise after the actual acquisition or after the access to capital as a debt, outstanding debt. And then we have our long-term liabilities, which are our note payables, our mortgage payables on any properties that we may have, our lines of credit for the business. So again, this is an area that we'll see people come in, they'll have debt on the books or off the books, but they'll say, I will see it coming through the account that they're making payments on a monthly basis, the same time a month. And then I ask them, hey, well, we see these payments. Well, what is your balance? How can you keep up on your balance if you're not accounting for it on your balance sheet? And what happens with that is, in a lot of cases, you can overpay. The bank makes mistakes. If you're at a smaller bank and they don't have the proper technology, and now they're taking it out. We've seen clients come through the doors that have overpaid on a loan for over a year period of time. The ACH was still coming out, but because it wasn't accounted for, the loan was not properly closed out or accounted for on their balance sheet. So that again is something that's why those are imperative. So now when we look at the equity, so the shareholders' equity in the company is the total assets minus its total liabilities. This represents the amount of money that you would be returned to shareholders if all assets were liquidated and all the company's debt was paid off. So retained earnings are the shareholders' equity and are the amount of net earnings that are not paid to the shareholders as dividends. So again, this is the importance of a balance sheet. Now, Meltrice, you want to add anything to that?
No, I think you did a good job. I know you'll touch a little bit more when we talk about net worth, but I think, well, I said no, but I really meant yes. I do want to add a little something to it. I just want to make sure that people understand the criticality of not just looking at their profit and loss statement or making their tax filing transactional, right? Because that's what we see a lot in our business is, we have businesses, they will bring us a box of receipts at the end of or the beginning of the next year to prepare their taxes for the previous year. And, when you do that to a tax accountant, basically, essentially all you're saying is that this is the transactional activity for me. It's not really meaningful to my business. So that tells us that you're not using data to drive decisions. And because it's transactional, we can't give you the best outcome. We can give you the best outcome when your financials, your accounting is very relational, meaning I know more about your business. I know about a lot of the major financial decisions that you're making. I can account for that as I'm doing your bookkeeping and your accounting. I can give you strategic ideas and advice throughout the year to help you avoid some pitfalls or to help you capitalize on certain activities or opportunities. But when you make your accounting a second thought, that's when you run into issues. That's when you're unable to cash flow projects because you're unable to become bankable because you don't have the right financial statements or package. You don't have the right financial insight into your business. So profit and loss statements, balance sheets, some of the other things that we're talking about today are very, very critical. They shouldn't be second thoughts. They should be the first thing that you do as you start your business.
Let me add to that as well, Meltrice, because a common thing we see, and especially when we're dealing in this particular industry as well, is that people, when they're starting up projects, because cash flow can get tight, which we'll talk about a little later in the presentation as well, they'll utilize personal credit cards and they'll use personal assets to fund a project and not account for it properly. So if we're not, as your accountant, or if you're working with another accountant, or even yourself, not accounting for those personal expenses, that those are business expenses, but you utilize personal vehicles to do it, what you're going to do is it affects you from a tax perspective, because now you're leaving those expenses out of your business. So then now you think you're more profitable than you truly are. And so now you're paying at a higher tax rate or paying more towards taxes, and it's inaccurate. So it's imperative that as you're running this, one, I'm not to dive into that to get off subject, but it's imperative as you're running this business that you are running it from a business account. And I would say if you're utilizing personal funds, that you write that check to the actual business and not just use it out your personal account, and then create that as an owner investment on your balance sheet, so then you are aware of that capital investment or owner's investment you make into the business. But we get in a lot of cases. I'm like, hey, you have this full project, but I don't see any of the expenses coming out your books, what's taking place. So make sure you're accounting for that, because again, it affects you from a profitability perspective, and it also can affect you from a access to capital and a tax perspective. And then I'll say the last time, because this is imperative, that you don't leave any liabilities off of your balance sheet, especially as you're expanding, because in most cases when you're expanding, you're going to go look for capital, or what you're going to do is you're going to be going from project to project, and you're going to be waiting for the next project to fund the next project. And what you're going to do is it's going to be a reputational hit, because you'll never be able to function and complete one project at a time, because you're always chasing the next dollar to finish the prior project. So again, that accounts receivable is important, but also making sure that you account for those liabilities. So when you do get debt, that you don't make sure that you're overdoing it for your company and you're taking out debt that you really can't afford because you didn't account for debt that you have outstanding because it's not on your books.
Absolutely. So, okay, I was trying to switch over to the slides. I apologize for that delay. So we'll take a pause for a minute, because I do want to do a couple of polling questions. The first polling question, Victoria, if you don't mind helping us out with that, is how frequently do you receive financial statements from your accountant and review your financial statements with your accountant? Is it monthly, quarterly, annually, in preparation of your taxes, never, or sporadically?
I've put that
We'll
poll
give you
question up.
a
Yep. Sorry.
couple of minutes to respond to that polling question. Thank you.
Okay. Thanks. And as you're responding to the question, I wanted to let our presenters know once they've finished answering and I close the poll, I will share the results and read them off, because I don't believe that you as presenters actually get to see the results. It's just a little quirk in the
Okay.
system. So, but we've had 55% of the audience vote. So I'm hoping we can get up over 70%. How about a few more votes here? And then
Okay.
I'll go ahead and close the poll out. Oh, yeah, here we go. A few more votes coming in.
And hope you guys are being audience. We're not the accountant police.
Yeah.
But,
We're not saving your answers, so please.
We're not saving your answers. We're not going to come knocking at your door.
Yeah. Okay, here we go. I'm going to close the poll down and I'm going to share the responses. For monthly, you have the response of 23%. Quarterly is your highest at 38%.
Okay.
Annually, in preparation of taxes, is 31%. Never, thank goodness, was at 0.
Thank goodness.
And then, yeah, sporadically is at 8%. So I'll hide those responses.
So that's awesome. Like Victoria said, thank goodness no one was at 0%. So it sounds like with the ones that are sporadically, you need to work your way to doing this more monthly. We meet with our client, most of our clients monthly, to review their financial results. We think it's really important that our clients are making data-driven decisions infrequently, right? So if you are working on projects and different projects throughout the quarter, then if you're waiting until the quarter to review, then you can really have some big misses there. So the ideal is to review as frequently as possible, but at minimum with your accountant, you should be reviewing monthly. I'm going to ask another more open-ended question before we go into the next topic, and it's all about ratios. Ratios is something that are really, really key. We talk about, your financial statements. Larissa talked about income statement, profit and loss, balance sheet. But really, there's a comprehensive financial package that's important. And as a part of that package, you really have to be looking at your industry specific ratios. So we're going to talk a little bit about some of those ratios today. But before we do, can you guys kind of throw maybe in the chat, what are some ratios that you use or that you're speaking to, either with your accountant or with your team, and you're looking at those ratios to help determine the financial health of your business?
We actually have a question that came in before you asked for them to give you ratios. So I'm going
Okay,
to read that off while they're thinking about their ratios and put them in. It says,
okay.
how is the depreciation on equipment determined? Is it by publication, formula, etc.?
So that's a great question. There are multiple depreciation methods. Straight line is one of the most popular, most commonly used method because it's simple and easy to use, but depending upon what type of equipment you have, you might use a different ratio, but a different method, but it is a calculation based on the cost, based on when that equipment went into use, based on the estimated years of its useful life, and based on the salvage value. So it is a formula, and your accountant would work with you based on the type of equipment to determine what's the best depreciation method to use on which type of equipment and what are the right formulas in order to calculate that. You want to add anything to that, Larissa?
That was, I was going to say, great question and great answer for it.
Yep.
But I do want to say something before we jump into the ratios. I was just thinking about the polling question. When we talked about what we usually do for our clients, but the importance of something is to consider as you've determined. I know every company on here may be at a different level, but we look at annual. That we always say that that's being more reactive. Something you may want to consider is if you're doing yearly, you may want to go at least to doing quarterly, because what that allows you to do from a tax perspective is also, if you're profitable as a business, you want to make sure you're paying those estimated quarterly taxes as a business. And then if you're doing it annually, what it's not allowing you to do is be proactive to create approaches or strategies to ensure that you're decreasing your tax liability and create, after tax wealth. So that's just something that we would just give as, just a tip, as you're considering how often you look at your financials, because there are tax implications to that as well.
Absolutely. Many of our clients come in and they tell us, we want to pay as little taxes as possible. And we're like, well, we're not the firm for you. We are going to take advantage of every legal opportunity. But what our goal is to maximize after-tax wealth. And the only way we can really do that is to know you, right? Is to know your business. And we can't do that if, again, there's a transactional relationship between us where you're only coming once at the end of the year and you're expecting us to get you the best results. It really is a relational relationship that needs to occur between you and your tax accountant, period, in order to get you the best outcomes. Did we, Victoria? Oh, go ahead. We love this topic. So Larissa's going to say, oh, wait, one more thing. And I'm going to say one more thing.
This is my last, one more thing, I promise. But it's, this is so imperative, and it's just a very, great topic just to talk about again. It just allows us to be, the key word is proactive. We want to be proactive throughout, and we're able to be more strategic. And I think what's important and we'll get into this as we talk about how to pick an accountant, but you want to make sure that you're just not getting a document, but you're not really reviewing it and being educated on that document, but you're also creating strategy along with it, because again, the goal is to go from being a business to an enterprise. So of course it takes strategy, it takes being educated about your financials, And then, of course, just again, that strategy is just important, proactively.
And our word this year is being deliberate and intentional. Every year our firm comes up with our themes, and this year it's like being intentional and deliberate. And when you're doing that, you can take a small business and become an enterprise. And just think about it, every enterprise started off as a small business. So with the right strategies, there's no difference between them and you. So Victoria, did we get any responses for ratios?
Somebody said ROI, but otherwise there
Okay.
weren't any other
Return
responses
on
in there.
investment. Okay. All right. Well, that's fair. So, I mean, I know that what we're talking about can be a little overwhelming, especially when we're talking about finances, right? Because if you're probably saying to yourself, look, I'm really good at building stuff. I'm really good at fixing stuff. But what I am not good at is numbers. And I would say the same thing if you put me on a hard hat and I had to go on a construction site and I had to determine what angles and what sides, I would be losing my mind. I would feel like someone is talking in a foreign language. So I know that this can be overwhelming. And so the ideal is not that you take what we're sharing with you today and now you can do your own accounting and your bookkeeping. The ideal is that you take your takeaways from this is that at least I have enough of an understanding that I can, one, hire the right person, the right individual or the right firm, and that I can manage the process. I can ask the right questions, and I can take the information that they're giving me to evolve my business and grow my business into the enterprise that I would like to see. And so ratios is really helpful with that, because sometimes balance sheet, profit and loss, it can be a little complex. Ratios are really simple key calculations that are key, what we call in the industry, key performance indicators, KPIs, that tell you a lot about the financial health of your organizations. But ratios just by themselves is not good enough, right? Everything that we're talking about, you have to do it together. But even with ratios, there's an extra layer, right? You have to look at what were my historical ratios. What's the industry standard for a company that is a like-sized company like mine? What is the standard? What should my outcomes be with these ratios? And then the third thing is, what about my competitors? How are my competitors doing in these ratios? And that's why for our clients, we determine what are the ratios for that particular industry, and we share those ratios and we talk to them about those ratios very often. So I am going to try to advance the slide. Bear with me.
I need to give you back the presenter status.
Okay.
Let me do that real quick.
Technology, I love it, and I sometimes don't love it, but
You just have to
okay.
pass it back and forth between you guys.
Just have to pass it back and forth. Okay.
Looks good. We can see it full
Okay,
screen.
so that's good. So let me see if I can advance. All righty. I think I'm there. So, but I only can see a part of the slide, so I apologize. I'm going to look at my paper slides. All right. So so there are ratios that I'm going to talk about a little bit today. I'm not going to drain the slide, but we're going to talk about project margins, gross profit margins, profit margins, which are different than project margins. And we're going to talk about these key quick ratios, current ratios, working capital turnover, and debt to equity. So these are key ratios for construction businesses. The first two ratios I'm going to talk about are really your liquidity ratios. Your liquidity ratios, I am having an issue, Victoria. Hold on. I can't see anymore. Oh, there we go. Okay. All right. All right. I apologize. So your liquidity ratios are ratios that are used to determine whether or not the company has the ability to pay off short-term debt when it becomes due using current assets. So it basically assesses whether or not you have enough assets to handle debt. This is a ratio that banks use often to make sure that if you are trying to become bankable and get access to capital, that you can handle the liability when it becomes due. The first ratio that we use, and that's most common, is called the current ratio. Very, very simple formula that just takes your current assets and divide it by your current liabilities and come up with this number. So basically what this is saying is that if you were to liquidate your current assets, which what Larry showed you your balance sheet, you saw your current assets were your cash, your short-term investments, your inventory, your accounts receivable. If you were to liquidate that, can you pay off your current liabilities? So when you get this ratio, anything that's greater than 1 is considered good, because it's basically saying at the bare minimum, you can take your current assets and pay off your current liabilities. If you get something like that's 2 or higher, you ask yourself, oh, it's higher. Is that a greater thing for me? And sometimes it's not as great, because what that tells an investor or a banker is that you have unused assets. Like you're not leveraging your assets to grow your business. So you're not taking on enough risk. So you want to have enough to cover it, but you don't want to have too much, which means you're not taking on enough risk to grow your business. Another liquidity ratio that's used most frequently in this industry is called the quick ratio, and let me go back, because I do want to let you know that the current ratio is sometimes called the current rate working capital ratio as well. The quick ratio is often called the asset test ratio, which is almost like the same as the current ratio, except you're only looking at very highly liquid assets. So you're only looking at your cash, your short-term investments that's so close to maturity that they're not going to fluctuate in value, and you're only looking at your receivables. So what it's saying is those highly liquid assets, if you convert those to cash, can you cover your liabilities without looking at those more challenging assets that you would have to convert to cash? Like inventory can sometimes be very challenging to convert to cash, and then under billings can be very hard to convert to cash because the collection effort is very difficult. So your quick ratio is those really highly liquid assets. Are they enough? Is the value enough if liquidated to handle your current liabilities? So those are your liquidity ratios that you really should be looking at often. And I got to tell you that if you're not looking at them, then if you want to gain access to access to capital, banks are definitely looking at them. So those are two really critical ratios. The next ratio I'm going to talk about is called your leverage ratio. Your leverage ratio looks at how a company finances its assets and its operations, right? And so sometimes people will say a company is highly leveraged, which means that they are financing their operations and their assets by use of debt. So the most commonly used ratio for that is called your debt to equity ratio. Very, very simple calculation, which basically takes your debt and divide it by your equity. And it's basically saying, are you using equity, which is ownership, or are you using debt, right, to manage that? And so banks will say, if you're using too much debt, you're highly leveraged. They're not really interested in giving you more money because there's a concern that you will have an inability to pay that debt when it becomes due. But if you're not highly leveraged, then you're paying a lot of your operations and your assets with equity, which is a good thing. The last thing I'm going to talk about is an efficiency ratio, which is working capital turnover ratio. It tells you basically how well a company is managing its assets and its liabilities. It's a really simple calculation. It's taking your sales and you're dividing it by your working capital. And we didn't talk about working capital, but working capital is just your assets minus your liabilities. Gives you your working capital. And so you want to make sure that you're able to use your capital to create sales in your business. So these are some of the important ratios that if you're not using today, you definitely, especially if you have an accountant, you definitely want to make sure that they're sharing these ratios, these outcomes with you frequently. And you're basically really using these to make data-driven decisions. The ones that I'm going to go to now are the first 3 bullets, and I'm going to, since I can't see them, I'm going to look at my notes. Your project margins. You guys are in the construction industry, so you know how important it is to understand your project margins. A lot of, I wouldn't say a lot of our clients, but a lot of people as prospective clients that are in the construction industry comes to our firm and they don't know, they think they believe that they're profitable, but they haven't documented, they don't see the profitability. And as Larice mentioned, are they including their own cash in it and thinking they're more profitable than they are. And so it's really, really important to look at your profitability from a project perspective. Each project should have its own mini P&L that says, how much revenue am I generating? What are the expenses I'm paying out? And what is my net profit? And that would be your project margin. Your gross profit that I see on there is basically your overall sales for the business as a whole minus your cost of goods sold, right? So your gross margin is going to tell you what value do I have left over to pay everything else that I have to pay after I've purchased my goods and my material for this particular project. Really, really important, because that's going to tell you how much money do you have left over to do other things on that project. Not share with subs, but how much money do I have left over to pay my subs? How much left over do I have to pay my vendors? And how do I need to manage that to ensure that I have enough left over for all of that stuff? And sometimes it's a matter of looking at where you're getting your supplies and material for. If your gross margins are not high enough, you need to look at, am I buying my material from the right vendor? Are my terms and conditions for that contract accurate? You know, so these are some of the questions that you'll ask once you understand what your gross profit margins are. And then the last thing is your profit margin. So that is your sales minus your cost of goods sales, which gives you your gross margin minus everything else, and it gives you your profit margin. So if you're not looking at your business critically through that type of a lens, then you could be wasting money. You could be, throwing money in a black hole. You don't have the data that you need in order to effectively manage your business and your projects. So those are the ratios. I'm going to pause a minute to ask, are there any questions as it relates to ratios?
There's none in the question box, but people can always unmute themselves and ask too. I didn't mute them back.
Okay.
So
we'll give it a minute, and I'm trying to advance the slide.
yeah, the audience is doing great at not having a ton of background noise. So I'm just going to leave everybody unmuted, and they could just have dialogue with you.
Perfect. So as I'm waiting to see if there's any questions, I do want to say that no single ratio will cover all bases, just like no single statement will cover all bases. It's really, really critical for you to combine every last one of these financial statements and ratios that we're talking about to give you a holistic viewpoint of the health of your business. Okay.
But I'll say, to answer that, Meltrice, the importance of these ratios, you can't compile these ratios without accurate statements.
That's true.
So that's imperative. So when you go to get access to capital and you sometimes wonder, why do I continue to have challenges or not be able to get the level of access I need, is because those financial statements that are being derived from yourself or your accountant are being put into systems within these institutions that are creating these ratios for you so they can make a determination. So again, like they say, garbage in, garbage out. So, that's so important to, the importance of keeping accurate and timely financial statements.
Absolutely, Larice. We often tell our clients, like, when you know what you have going into the door, then you can negotiate what you want going out of the door, right? So if you know your ratios, a bank can't tell you what your ratios are. If you know the financial health of your organization, a bank can't tell you that. And so what does that mean? That means you go in and you say, I need whatever value you need at this interest rate, because you're clear on what the interest rates are. And if you can't give it to me, given the financial health of my business, then I'll go to your competitor who will. And banks oftentimes, and I would say not oftentimes, all the time, they only want to lend to people who don't need it, who don't need the money, right? Which really shows your credit worthiness. And the more you know this, even if you start off and it's not good, it doesn't really look good to you, at least you have a baseline, just a starting point, so you know what you're working toward. And that will really help you to become bankable in very short order. So, Victoria, do we have any questions, or are we doing that good or that bad that we don't have any questions?
I would say you're doing that good. This is a topic I think people really need to listen to and digest. So your explanations, I feel, are right on point, and the audience can, put comments in the question box if they don't feel that they are on point or if they have more questions about it. But I think
Perfect.
we're good.
Thank you so much. So I like to put up another polling question, Victoria. Do you use cash flow statements to manage your cash? Yes, this is really a yes, no, or what is a cash flow? Some of you might be asking, what is a cash flow? So Victoria is going to open that polling question for us.
It's up there, and if you're having an issue getting your answer to record on the screen, hit the escape button on your keyboard, because you're probably in full screen mode, and if you're in full screen mode, it won't take an answer. Boy, they're voting fast and furious on this. It's going to be interesting. All right, we're almost there.
I don't know what I just did. I just did something where I can't see myself anymore. Or I can't see.
Look for that little, looks like a little flower icon on your bar, your toolbar, press it, and it should bring you back to the front. I'm going to close the survey out now and share the results.
Okay.
We have 60% that said yes, 20% said no, and 20% said, what is a cash flow statement?
Wow.
So I'll hide that.
That's
It's all
awesome.
yours.
I appreciate your honesty. And cash flow, some accountants would argue with me, and that's fine. To me, as I mentioned before, no statement is more useful than the other one. I mean, it really is a comprehensive look, but the cash flow statement is one that's near and dear to my heart. It's one of the most complex statements, but it's one of the most important statements, because oftentimes, your profit and loss statement doesn't give you a full picture, especially when you're doing accurate accounting, GAAP accounting, and you're using the accrual method. You're not going to get the view of your cash inflows and outflows from your profit and loss statement, but you will get them from your cash flow statement. So your cash flow statement, it provides information on your sources and uses of cash over a specified period of time. Larissa is going to speak more about sources and uses later, but it basically tells you, where did your cash come from and where did your cash go, which again, your profit and loss is not going to tell you that. And the main reason why is because a lot of times your profit and loss statement, again, if you're doing accurate GAAP accounting, has some things that are non-cash in it. So I'll give you a few examples of that. One of the examples is what we just talked about, depreciation, right? Your depreciation expense will be found on your profit and loss statement, which will essentially reduce your overall profit, but it's a non-cash activity. Another thing would be is invoices or billings to your clients. So you might invoice, which is GAAP accounting. Once you perform the work, you can invoice, and record revenue for that, right? You record revenue when it's earned. So once it's earned, you invoice, that becomes revenue on your P&L. However, sending an invoice to a client doesn't mean that that client paid you, right? And so you'll have revenue, but then you still have a high receivable and no cash collections. Same thing on the opposite end, whereas if you have a bill that you received and you're recording it as an expense on your P&L, but you haven't paid out the dollars yet. So there are all of these instances where there are non-cash activity on your P&L, which a company can show profitable, but they really aren't, they really don't cash flow. So that's why it's really important to look at all of them together. Your cash flow statement is really, really important. Your cash flow statement is going to reconcile your accrual-based accounting to cash. And it's going to show you your cash inflow and your cash outflow in 3 very distinct areas. Those areas are cash flow from operations, which I call CFO, your cash flow from investments, which I call CFI, and your cash flow from financing, which we call CFF, right? And so when you look at your CFO, you're going to see all of your cash from your operations. This is really telling you, are you managing your operations effectively? Are your cash inflows greater than your cash outflows? And your cash inflows are going to come from customers. It's going to come from, your contracts and basically all of your customer revenue. Your cash outflow is going to go to your subs and your vendors and any other contract you have in place, your employees, right? And so when you look at your CFO, a high CFO means that you're a growing company, right? So if your income is higher than your outgoing and you have a high CFO, that means you have a growing company. If you have a shrinking company, watch out because your company is probably shrinking. If you have a CFO that is that's negative, that's a big issue because basically what that tells you is that you have more outflows in operations than you have inflows. And if that's consistent, which is why it's important to be looking at this frequently, if that's consistent, then you should have some real concerns about your business sustainability, right? So that is your cash from operations, your CFO. The next thing is your CFI, right? Bucketing your cash flows based on your investments. Your investments are those things that you're investing into the company to grow the company. So these are like your property, plant, and equipment. So your assets with an intent to grow the company. You can also invest in other companies. You can invest in stocks. You can, make any other investments in equity in other companies, any other investment in other companies. So you'll see cash go out on those investments. And you're usually only seeing cash come in with cash flow from investing activities if you're selling one of your investments, if you're selling one of your assets or anything like that. So your CFI is really important to understand. How are you investing in the company? The next and the last area is your cash flow from financing, which we acronym is CFF, right? Positive means that your business is raising funds. So you can raise funds from a whole lot of different ways. You can do debt. You can raise funds from doing a equity stock sale if you're a public company, or you can do it as owner, investing in your own company, right? So putting money. So it's anything that has to do with your investors and your creditors is going to fall in your financing area. If you're paying a distribution to your owners, that's going to be outflow of cash. If you're getting money and if you're investing money as an owner, that's going to be an inflow in cash. So the bottom line, after you net your CFO, your CFI, your CFF, you're going to get your net change in cash. And this is something that banks look at all the time. This is one of, I believe, banks' favorite statements. One of the things that they look at from your cash flow statement is something we call free cash flow. And your free cash flow is just your operating cash flow minus all of your capital expenditures. And basically what that tells banks is how much money does a company have after it covers its expenses. And that means that if they have money left over, then they have money to service a debt. So if we were to lend them money, we're very comfortable and confident that they can handle that debt. So that is cash flow. That's the cash flow statement. And I'm just going to show you an example of what a cash, if I can advance my slides, of what a cash flow statement looks like. Okay, so if you look at it, you see cash received from contracts, cash paid to suppliers. So if you look at this company has a negative CFO. So again, what did I say? If you have a negative CFO, this is something to be very mindful of, because what this is saying is, I apologize. What this is saying is your outflows of cash is higher than your inflows of cash. So you got to do a little bit more to manage your operations. Maybe you need to negotiate terms and conditions more with your vendors. Maybe you need to charge your clients, do more markups, charge your clients more. So there are all kinds of strategies that you can employ to make sure that you're changing that number. Because again, if that number is consistently negative, that can mean the sustainability of your business. That can mean you could be closing your business down in very short order. So it's really important to manage that. And then the next thing you see is cash flows from investing, proceeds from sale of equipment, purchases of property and equipment. So your proceeds is coming in. It means you had a gain on that sale. And then a change in due from affiliates. So as you can see, there's a positive inflow of cash for your CFI. And then your last thing is your CFO. You see that typically, again, looks like they are repaying some lines of credit, so that money is going out, and repaying long-term debt. And usually if you're borrowing long-term debt, there's no dollar value there, but usually that's an inflow of cash. And then repayments to your affiliates. So your net cash from financing activities, which is your CFF, is negative, which means you have a net cash, a negative net cash. So you're spending more than you're taking in. But this is a real depiction of what you're doing in terms of the management of your cash. So I know that's a lot, and this statement is really complex. And before I go into another complex topic, I'd like to stop, Victoria, and see if there are any questions.
No questions in the question box, but people can always unmute themselves to ask too.
Okay. We'll give it a minute. Okay, all right. Well, thank you for your time. We're almost at the home stretch. We know that this is a long session with very technical information. So take a moment to digest, but just, know that this is critical to your business. And, the best advice I can give you, and we'll talk about advice later, is don't rely on yourself unless you have the background, the skills, and the experience in this area. Don't rely on yourself to do this part of your business. We tell our clients all the time, at least I know I do, this is my favorite line to say, is that would you watch a YouTube video with an expert and see him extract a teeth, and now you have a tooth that needs to extract a tooth, and now you have a tooth that needs to be extracted? Are you going to try to extract your own tooth because you've watched a 2-hour YouTube video? And the answer, if you're intelligent, is probably no, right? And so I liken the work that we do to extracting a tooth. It's very technical, it's very challenging. You really need to have the background and experience to do it effectively. And so you allow somebody to do that so you can run your business and build things and fix things, which I can't do at all. So let's talk about the importance of cash flow management, right? And this just refers to how effectively are we managing the inflows and outflows, and not necessarily like I just talked about as it relates to the cash flow statement, but more so the timeliness of it. If you can make $1 million, right? you've serviced a whole bunch of clients, you build a beautiful project, but you have a whole bunch of invoices that are unpaid. And now you have a whole bunch of subs you have to pay, vendors you have to pay, and you haven't done an effective job at collections. That can cause you to shut your business down, not pay all of your vendors. We know of a personal story where a contractor had to walk off of a job because he no longer could cash flow the job. That's the worst thing in the world to happen, is you're cash flowing your current job with future job cash flows until that last future job cash flow ends, and now you can't cash flow any job. So managing the cash flow of your jobs, of your business, is really, really important. It's one of the biggest challenges, not just faced in the construction industry, but I would argue that it's one of the I would say it's more of a challenge in the construction industry than a lot of other industries, but it's one of the biggest challenges that most businesses face. Most small businesses close their doors because they don't effectively manage cash. As I was mentioning earlier, profit and loss, profit does not equal profitable. They're two different things, right? Profit and cash are two different things. You can show a profit on your business and be cash poor, right? So a company experiencing a net loss in their business might fail, but a customer experiencing negative cash flow will fail. And that is the distinct difference between the two. I want to advance my slides a little bit. I'm trying to. So I'm going to talk a little bit about, some ways that we can make sure that we are managing cash flow effectively. I'm going to read my slides a little bit because I can't see them based on this view that I have. The first thing is know your customer, right? So a lot of times as a small business, as a grow and thriving business, and this was a lesson that my partner and I had to learn very quickly in our business, is every customer is not our customer, right? So knowing what your proper customer profile is really important. And more importantly, research that customer. Research them to make sure they're credit worthy, because essentially either you're cash flowing or a loan that you have is cash flowing that project if you're not billing properly, right? So you want to make sure you're dealing with someone that's credit worthy. And understanding their payment process. I can't stress this enough. If you have a customer that says, I pay none of my contractors before net 60, that's something that you need to know in advance of taking that customer on, because you're going to have to manage your vendors and your subcontractors effectively enough that if they're paying you net 60, you have to make sure that you're paying your vendors and contractors net 60, or you need to renegotiate those terms if possible. Check their references. I don't care how big they are. I sit on a nonprofit board called National Association for Minority Contractors. We work with big contractors. That doesn't necessarily mean they pay their bills. So you want to check their references to make sure you're dealing with a contractor that's reputable, that's that pays their bills on time and do not, leave their small businesses and subcontractors with the bag. And you can even review their financials as well to make sure that they are profitable, that they are cash flowing, so that they have enough cash to pay their bills when they're due. So that's the first thing. The second thing is start with a realistic and profitable estimate. This is, and I know many of you probably attended Eric's estimating class, which was awesome, but this is by far one of the most important things, is making sure that you're estimating your projects properly to ensure that you are getting a profitable contract. And guess what? If it's not profitable, then let the next contractor have it. And that's just really important there. Be conservative with your estimations. And basically, when we in the accounting world says be conservative, we're simply just saying overestimate your expenses and underestimate your revenue. That's conservative. The next thing is performing a cash flow forecast or projection. And I'm going to show you 2 quick examples of that in just a short order, but you want to make sure that you are forecasting your cash flow so that you know at any given time where you may have to cash flow out of your own personal pocket, or you may have to take out a loan for that. So you're going to do that for every project. You're going to plan out how much work will be completed each week and or month, and how much you will bill your customer, right? Because it's all customizable. Some people will say 30, 30, 30, 10, but for me, it is based off of that projection and a conversation with your customer to say, I'm going to be done with this week. I'm going to bill you for this. You know, get that agreement in advance so there are no surprises and you are not floating the cash for that project. Consider how much you'll be paying vendors and subs so you can have a general idea of how much cash you will have at every stage of your project. And compare your forecast to your actual disbursements and receipts so you can make better forecasts in the future. One of the things we do with our clients all the time is we talk about budget. Because if you don't have a destination, any route you take will get you there, right? And so your budget is simply your destination. And if you don't revisit that after you've reached that place, you can't ask yourself, was there a better, faster way for me to get there? Was there a more efficient way for me to get there? And so you're revisiting that budget and that forecast with your actual expenditures frequently so you can make any adjustments along the way. The next thing is negotiating favorable contract and payment terms. Really critical part is making sure your payment terms with your vendors and your contract terms with your customers are scheduled in your company's best interest. And, you know, yes, there's a selfish component to that. Customers are definitely going to make sure that whatever you're providing them is in their best interest, right? Your subs are going to make sure whatever price you're paying them is in their best interest. It's up to you to make sure that you're negotiating this where it's in your best interest of the company. So you're not looking at like, oh my God, I'm not 50% through this contract yet, and I've spent $100,000 and I'm not even done, right? So that, and billing schedule should reflect the upfront costs of your project mobilization, like being paid for materials once they're delivered to the job site versus when they are installed. And I want to add another thing to this in terms of billing. Sometimes you just have to bill. I'm surprised at how many clients we have that they just don't bill their customers. So sometimes it's not just billing for mobility, but it's also just billing, right? So making sure you're billing, working with your vendors and subs to schedule your payments, attempt to get retainage phased out. For me, I don't like retainage. So if you can negotiate no retainage, that's the best outcome, but attempt to get it phased out and be sure to understand the terms and conditions outlined in the contract. Sometimes it helps to have an attorney review that with you, because a lot of times, a lot of that legalese sometimes goes right over our head. Again, a lot of times we're really good at our craft. We're really good at building things, fixing things, but when it comes to accounting, when it comes to legal jargon, we're not that good at it. And it's better to pay someone now than to pay them later. We always say pay now or pay later. Oftentimes you pay more later than you would have paid if you were proactive. Again, being deliberate and intentional. I'm talking a lot. I have to take a deep breath. Let's see how I do that. To the next slide. All righty. Can everyone see the next slide? Okay, so a couple of other things. Properly scheduling your project. The schedule drives the work drives the bill generates the cash flow, and so they all build on each other. So know when you're scheduled to start, stop, resume, and keep track of all of that. finalizing your project is really important. A lot of people get stuck at 98% completion, 95% completion and not finalizing that project. A lot of people, projects go on way longer than they should ever go on, right? So knowing that all of those things are interrelated are very important. Another thing is implement aggressive collection policies. When Larice showed that balance sheet, I think, what was it, $200,000 in receivables? Some of that can be retainage. We like to see retainage at less than 30% of that. But if it's not retainage, then that means someone owes you money. So you need to focus some energy and attention, or hiring someone to focus energy and attention on collecting those dollars. Again, if I'm a customer and you're not coming after me and my project is done, I don't really have the incentive to pay you unless you are following through and following up on that. Again, anything over 30 days is too much. So you want to be constantly looking at your AR aging, which is not a financial statement, a supplement statement that shows you what your receivables are in an aged manner. So current, 30, 60, 90. So anything above 30 is high. They say that anything above 90, you can only expect to collect 2% of that. So you don't want your receivables to go above 30%. Stay on top of your change orders. If you have to change something, you knock down a wall and now it's all moldy and you have to do some more work. Don't just have a conversation with your client. Document it in a change order and stay on top of your change orders. Change orders should be clearly established in the contract. Don't do extra work, provide extra labor without putting it in a change order. Again, close out your project. I said that already, so I won't drain that out, but closing out and collecting can be very tricky. So you want to make sure you have a fine-tuned process as you're doing that. And then the last thing I like to say, and the one thing I hope you take away, is implement the 5x5 rule. And I'm going to show you the 5x5 rule. Let me extend my... the 5x5 rule is simply reviewing the 5 schedules for 5 minutes a day every morning, right? And this is your cash available. How much cash do you have available to float projects, to pay vendors, to pay your subs? So you need to understand that every day. Where are you with your accurate cash balance, right? Not your bank statement balance, your accurate cash balance that includes all of your outstanding checks and all of your outstanding revenue. Your accounts receivable, again, I told you your accounts receivable, if your account is giving you the right supplement schedule, it's going to show you your age receivables. What are my current receivables, which I'm not that concerned about? If they're 30 days old, I need to start collections on these. If they're 60 or 90, I need to get very aggressive, because right now the likelihood of me collecting on those is very slim. Your accounts payable, who do I owe? And you need to look at that in an aging manner as well, because you don't want to pay people sooner than you should pay them. So if your vendors have a net 30, you want to be paying them 28 on day 29. If possible, you want to be paying them on day 30, right? Because cash is king. You want to hold your cash as long as you need it, so you can take advantage of every opportunity that presents itself, and so that you can float cash when you need to. So you want to manage your accounts payables in a very meaningful way. Your profit and loss, what Larice talked about, and your balance sheet. So if you took 5 minutes a day at the beginning of every day and you looked at these 5 statements, I guarantee you that this is going to elevate your business. Okay, I'm going to take 1 moment, change my slides up, and see if there are any. 1 moment and see if there are any questions.
None in the question box. And
None in
again,
the
people
question
can,
box?
oh, wait a minute, one just popped in. Hold on.
All
With
right.
the recent situation, where would received government assistance loans or PPP loans be recorded on a company's accounting ledger?
That's actually a great question. Thanks for that question, whoever that was. Until that loan is forgiven, it's debt. So it would be found on your balance sheet under your liabilities. Once it's forgiven, then it gets converted to revenue. Larice, you'd like to add anything to that? That's
Perfectly.
it. All right. All right, so I just want to share a quick 2 examples of cash flow and how ineffective cash flow can impact your business and how effective cash flow can impact your business. And so this one example is what I would deem to be an effective cash flow model. You have a project that is a $60,000 project. You forecasted that your cost of goods sold for the first month is going to be $25,000. Your overhead is going to be $5,000. The second month is $15,000 and $5,000 respectively, and then the last month is $0 and $5,000, right? And so you're going to manage your billings and your collections from the client in order to cover that, so you're not floating the cash from that project. So in the first month, you're going to have a $30,000 upfront payment. Okay, that's going to handle your first month of cash outflows. And then your beginning cash balance is $2,500. And so even if you're in a money market account where you're only generating 1% and you're allowing that money to sit there, then after that first month, you will have generated $25 in interest just by allowing that money to sit there. You don't have to touch it. The second month, you're going to bill at $20,000. That's going to cover your expenses again. Your $2,500 of beginning cash is still going to be sitting there earning a little bit of interest for you, right? So your $2,500 is working a little bit in the background. You're doing nothing, and it's working for you. And then the last month where your expenses are only $5,000 and you've billed for $10,000 and collected for that $10,000, now you have a return on that project, or what I would call a profit margin of $5,000. And so now you have $5,000 plus your $2,500 that you did not have to touch with the interest that you've earned. So a total of $5,050 for that particular project. That same project, I think I was showing the wrong slide. I was showing the good example. I'm sorry. See, this is what happens when no one tells you you don't have the right slide. Even my partner didn't tell me I was like speaking to the wrong slide. So this is the project slide I was just talking about, where your profit is $5,050 because you're earning interest and you've effectively billed your clients in advance of absorbing the cost for the project. And then the bad example, which I wouldn't say bad example, but I would say this is kind of where you're not managing, you're not forecasting appropriately, estimating appropriately, and billing and collecting appropriately, is the first example that I had up, which I'm going to take my slide back to, which is where you are floating the cash for that project, right? So this is where we said, oh, it's 60,000. We're going to do a 3-way split, right? 20-20-20 over the 3 months of the project. When your estimated cost for the first month is 30,000. So what that says is, in the first month, you are floating, you are being a lender to your client for $10,000. So if you are managing your clients this way, you had better know your customer, because essentially you're lending them money, and banks don't lend money to people who don't need it. So if you know your customer and you know your customer is good for it, then by all means lend them the money. But if you don't know your customer is good for this $10,000, this could cause issues with this project and future projects, because you can't continue to float your cash in that way. So in this instance, you're floating $10,000 in the first month. The second month, you're still negative. You don't become positive until the last month of the project, which could mean an issue for your subs, your vendors, your other future projects, or your projects that are happening simultaneously. It can mean a whole bunch. So just wanted to show you 2 examples of when we think that a client is effectively managing cash versus when a client is not effectively managing cash. So I've talked a long time. I'm tired. I am going to then transition it over to my partner, who will talk about, sorry, I had to take a deep breath. Talk about sources and uses of cash.
All right, I'm going to go ahead and move the presenter status over to Larice.
Okay.
And while I'm doing that, I wanted to mention that there was a question in the question box about the presentation. And at first I thought they meant just the handout, which is available in the handout section to download. But they're talking about actually the recording of this presentation. We'll send out a link to that when it's all finished. We have to let the video software process it, but we will send a link out to everybody who's been on the webinar. So just watch for a follow-up link from our office. Thanks.
Thanks, Victoria. Great job, partner. Great way to transition. I'm going to run through these last couple topics because we kind of talked to the 3 statements pretty in depth, and I want to leave some time for Q&A at the end. So we're running on the 4 o'clock hour in about 20 minutes. So when we talk about sources and use of funds, as you can see the example there, we can see sources being activities that yield cash. So that comes down to sales, owner's cash, investment, line of credit, loans, and then your use of cash, which is working capital, investment cash, reserve, cover project costs, purchase of building and equipment. So a couple other examples of that would be is a decrease. So when we talk about your sources of fund, we would talk about a decrease in liabilities or an increase in assets, a net income after tax, disposal or reevaluation of fixed assets, all things that hit the different statements that we previously discussed. Proceeds of loans obtained, like we discussed and I showed in the example, proceeds of shares that were issued if you're a public company, repayments received on loans or previously granted by your organization, and any increase in net working capital. So those could be other examples as well. Now, another word I guess you can use is use of funds. So that's where the money has gone. So the difference is source is where the money has come from, and use is where the money has gone. So your use would be the purchase of any fixed assets or investments that would show up on your balance sheet, the full or partial payment of loans, granting of loans, liability for taxes, any dividends paid or proposed, any decrease in net working capital, any expenses that you spent, again, on equipment and supplies utilized. So again, being pretty straightforward. So it just says the sources and use statement really just simply shows where all the sources from a project have come from and where all the funds have gone and been used within that project. This is important because it tells about how funds flow through a project, describes the funds flow through a project like we discussed. And a key requirement of the sources and statement, uses statement, is a total of sources of fund must match the total uses of funds. All the money has to go somewhere, and the sources and uses statement shows where. So the next thing is net worth of an organization. And this will be our final topic before we just get into just giving you some tips on on how to hire an accountant and some other technology things we want to share with you today. So net worth. Now, net worth really truly reflects what the owners or investors in the company would have remaining. All assets were liquidated and the proceeds were used to pay off all the creditors. It really is a company's balance sheet that I'm going to show you an example. In other words, it's the net amount of money that owners have invested in a company. And of course, we know the balance sheet is assets equals liability plus owner's equity. Now, something I want to give some advice to you as owners is, you can print off a sample of this, because this has become a common practice for a lot of our clients when they're going after access to capital. Is something called a personal financial statement. So not only are you doing that for the business, but you're doing it on the personal side, and it follows the same antics where it's looking at your assets as an individual, liability, what is owed, and then what has been invested is your owner's equity within that. So that could be something you can do on the personal side. We were just working with some clients recently, and the bank not only asked for these 3 statements, but they also want to know the net worth of that individual as well. So when you look at the net worth on a balance sheet, like we talked about, we went through this previously, that assets are what you own. So again, including your cash and current assets, your investments, your property, plant, equipment, as well as your inventory. And then your liabilities being what you owe, which are your current liabilities, your notes payables, your accounts payable that Meltrice went in depth about as well, your tax payable, and then your long-term liabilities, your notes payable, if you have any bonds based on the type of project that you have. And then we talked about, someone asked a question about your PPP. And like Meltrice stated, if it has not been forgiven until it is forgiven, this is going to show as a liability on your actual balance sheet and affects your net worth as an organization. And then what you have left over is your stockholders' equity. And that truly is how you derive and come, to calculate what the net worth of that business is. So when people are doing evaluation of an organization, that's why we talk about the importance of your balance sheet, because it has to show the entire picture for them to be able to establish what the net worth is, and then therefore figuring out what is the valuation of that organization based on these reports. Now, the thing I think is important is, okay, we talked about all these components, important financial statements that are imperative for the efficiency and success of your business. Now it's like Meltrice gave the example of, you're not going to watch a YouTube video and figure out how to extract your own teeth is. So in this case, if you don't already have those in place, those financial statements, which we saw some of the poll responses, or that based on this conversation today, it needs to be elevated. Well, how do I hire an accountant?
Larice, can I interrupt you for a minute?
Please,
so we
please.
can do a couple polling questions before you move forward. Let's do a polling question. Do you know the current value of your business? Because Larice talked about kind of looking at your balance sheet and looking at the 3 O's, we like to call it: what you own, what you owe, and what's left over. That's just a part of it. Banks and businesses that acquire other businesses, there's a huge valuation in the value of the business. So the question to you is, do you know the current value of your business?
And we're
Answer
collecting
is
those
yes, no,
results. Yep.
yes, no, or what do you mean by value?
People are voting pretty quickly. And again, we are not recording what you answer, so just answer freely. We don't know what your individual vote is.
Right.
Okay, looks like we're pretty well there. I'm going to go ahead and close the poll down and share the results out.
Awesome.
50% said yes.
Oh, that's wonderful.
And that's your highest. We did have 42% that said no, and 8% wanted to know what you meant by the value of their business. I'll hide that.
That's I think that's really good. Again, understanding who you are and the value that your business has in the market. Because again, we like to say start with the end in mind. And eventually I think a lot of us will want to sell our business for millions and millions of dollars and go retire on the beach somewhere. But understanding the value of your business and understanding what the value you want to aspire to and how to get there is really, really important. and the people who said, what is the value of the business? I would say it's a complex. We try to simplify it, but there's no real simple way. It's a really complex calculation that says if everything was liquidated in this business, what is left over, or if you were to sell this business today, what can someone who is purchasing this business expect to get once they acquire the business? So it's a pretty complex calculation.
Yeah, and just giving some tips on that as well and that's why the importance of having these financial statements, again, talking to the accuracy, because again, if you're leaving out certain assets or you're leaving out cash and you're not accounting for it, when someone goes to do a valuation in the possible sale of your organization, then what you're doing is you're undervaluing your company. And then the other thing I'll say to that as well is, beyond just your accountant, and we're going to talk about some partners. It is organizations, a lot of financial institutions in the community actually have valuation programs within their business banking division. And a lot of local, again, financial institutions will work with you once you have accurate financial statements in place to help you come up with that valuation. So that is something that I would emphasize even more and encourage you. If you have not figured out that valuation in your business, that's something that will keep you motivated, and also as an owner to know actually what is a part of your legacy as you move forward, the actual value in your net worth as an individual. So
yeah, so let's do the last polling question. Are you currently working with an accountant? Yes, no, I do accounting work myself, which we see frequently. Or other. Other is usually no. My cousin who used to do some accounting work on the side does my accounting work, or I don't know, what's some other examples, Larice, that we hear a lot? My cousin them.
yeah, my cousin them say that accounts are too expensive.
Yeah.
And I can figure it out myself. I can just use Excel to figure out a complex situation.
Mm-hmm.
We are getting there with the voting, so I'll be giving you the results here in a second.
Perfect.
Okay, here we go. I'm going to close the poll down and share the results. We have 64%
Oh, that's real good.
said yes. Yes. Nobody said no. 9% are doing the work themselves, and 27% have their cousin Vinny doing it.
Okay.
I just threw that in there for comic relief. Everybody
Yeah,
remembers
we
the
need
movie My
we
Cousin
need
Vinny,
comic
right?
relief.
Yeah.
Yeah, thanks for
Yes.
the comic relief. This is some pretty heavy
Oh,
stuff.
wait a minute. Somebody wanted to clarify that's not their cousin Vinny. They said other means I work with an auditing department. Good for you.
Okay.
Great. And I would say, I mean, this is the polling results have been actually above industry average when we're teaching similar courses. So so congrats to you. And I would just encourage those who may not have that relationship. We're going to dive into the next slide to talk about, how do you hire an accountant and things to consider. So we can.
I think the slide is up. The 3 C's.
Yeah, Victoria, can you? It's not showing on my
Yes,
screen.
I can see the 3 C's. Oh, there we go. Question and answers.
Okay,
You
no,
did
there
all
we go.
3 C's again. Okay.
So it's not showing up on my screen, but I'll go ahead and read off of it. But the 3 C's when thinking about hiring an accountant is the first C being care. Do they care? Are they responsive? And when we say responsive, realistic responses, we're not saying that every time you send them a text or send them an email, but are they responding within an appropriate time within 24 to 48 hours of your questions? Do they answer your questions? Are they listening to what you're asking? And are they providing you the necessary information for you to be productive? Are they available when you need them? Are they only waiting till tax time to see you and not being more proactive versus reactive. And then, are they competent? That's the next C. Are they competent? Do they have the credentials to fill your needs? Do they have references of clients in the construction industry? So have they provided you that? And again, do they have the background? Do they have the insight? Do they know the ratios and KPIs that mirror your particular industry? And then the last being costs. Can you afford them? Are they competitive? Now, what we always say is you don't want the cheapest, but you may not want the most expensive, but you also pay for what you get. Do they provide transparent pricing? No surprise fluctuations in pricing. And so what I'll say to that, when we talk about costs is, are they providing you what we provide our clients, our statement of work that is clear and concise of what the service they're going to provide to you, and then the actual cost of that service. So again, there's no surprises at month end on what those costs are. And you can, like we talked about earlier, is appropriately budget, your expenses as an organization. So those are the 3 C's. Now, to add value as well is technology. As we talked about everything we talked about, we see 60% of you already have an accountant, 27% may be working with some other organization, but do you have QuickBooks in place? So if you're working off an Excel spreadsheet and you're taking on, I would say, higher level projects and need to elevate your organization and gain access to capital and prepare yourself for the future, you want to make sure that you, at the minimum, have QuickBooks in place. So then you can properly account for your transaction on a continuous and timely basis to help you, I would say, generate the 3 reports that we talked about previously. Then also, something that's very common for us in Meltrice, you talked about it earlier when you said people bring us bags of receipts. Now, when we talk about contractors, you're going in, you're buying supplies, you're buying gasoline, you're paying for maintenance of vehicles, you're paying people sometimes not in the most accurate and efficient way through Cash App, through writing a check through cash. You want to make sure that there's receipt documentation, I would say technologies out there, the ones like Dex, that you can take a snapshot of your actual receipts. So then we know if you do an activity in January and then you go ready for tax season the following January with your tax accountant, in most cases, what happens? The ink has worn off of those receipts. So not only now can you not account for the expense, but they can either tell you what that actual expense was for. So again, just having those sort of technologies, Yardi being one if you're doing property management as well. Technologies are key to enhancing your efficiencies in these areas. And then the last thing I'll talk about is we call it the power of 5. Partners. Oh, payroll. Oh, sorry. Yes. Technology, yes. Payroll. Making sure that you actually have a payroll system in place that will allow, again, because we know in this industry, we see a lot of clients come through the door and they're working with subcontractors or contractors that do not want to provide the W-9 to be accounted for. And then they're paying themselves untraditionally, just taking money out the checking account or Cash App in or squaring someone. But payroll is going to ensure that, one, that you're being efficient, and then that you're able to then document properly from an accounting perspective and even from a tax perspective. Because remember, if you're not accounting for that payroll for them, or you're not providing the right tax documents, that you can't properly expense those expenses or that cash that you're paying out. So we want to make sure from an efficiency perspective that we put a payroll system in place for you. Now, the partners that we talk about, we call it the power of 5. We talk about the 5 people that help you to be more efficient as a business. One being your accountant, to say that first, shameless plug. 2 being your attorney, excuse me. Then 3 being your business banker. Then your investment banker or financial advisor. And then being your insurance broker. I mean, all these people are, I would say you want to follow those 3 C's to ensure that they meet all those criteria that we discussed. And if you put them together as a team, it will help to make you that much more efficient as an organization. So then we can go into the last slide of Q&A. And we thank you, and we're just so elated that we stayed almost at 100% up to this point. And thank you for your time and your just being in attendance to this seminar today.
Yes. And I know we go ahead. I'm sorry, Victoria.
So this would be a great time if people have questions for them to unmute themselves and ask.
Yes. I know we've opened up the floor for questions throughout the presentation. So Laurice, if you don't mind advancing the slide, because I do want to talk a little bit about CLE as we're closing out and waiting for people to either have a question, state their question, or type their question in the chat. Again, CLE is a firm that we started 4 years ago. We actually just celebrated our 4-year anniversary in March. And again, although the firm is new, we're not new to the industry. We've been in the accounting and finance industry for almost 20 years, both of us individually in our respective backgrounds. And this is what we eat, breathe, and drink. And we love it. And we have a true commitment to helping small businesses elevate their business. So it's not just about the numbers for us. It's about seeing businesses grow from the small business to the enterprise, which we've been lucky enough to see our clients start off. Some of our clients start off with 1 location and now they're at 6 or 7 or 8. And so it's a wonderful and rewarding thing to see. But I did want to talk about the 4 services that we offer. We like to say that we are the the 5 guys of accounting. We are not the Ponderosa. We offer payroll. So our sweet spot is any company that has 50 or less employees and or contractors. We are probably going to be the best solution provider. I'm sure I'm very biased when I say that, but there's an extra layer of support, and there's something comforting about knowing when I call, I know who I'm going to speak to, and I know that person is going to get me the answer or the solution that I need in very short order. So that's our payroll services. We do also offer tax services. And we're very competent with the construction industry. So we offer tax services for, even the individual, 1040 EZ, all the way through the corporation. So if you have to do an 1120, that's something that we can definitely support and help out with. Accounting, so bookkeeping. So even for those smaller construction companies where all you really may need at this time as you're growing is bookkeeping, we do bookkeeping and accounting, and we all the way to your complex CFO outsource model where we're doing the collections, the invoicing, the payments for companies. And then the last thing is business consulting. We do a lot of consulting. It's sometimes challenging. I find myself very lucky that I have a wonderful partner. We can vet ideas with each other. We can leverage each other's background and experience. My business is not limited to my knowledge because I have a partner. Essentially, in our business consulting, we are your other partner, someone that can help you vet, especially those very complex financial transactions, answer other questions and stuff that you might have, or just someone to have conversations with about the business. Our business consulting part of our business is really a growing and thriving part of our business. So that is us in a nutshell. We would love to service those that don't have an accountant or those that answer other. In any other way that you could think that we would be helpful, we would love to service you or at least have a conversation with you. You can call us at 216-800-9021. Our offices are conveniently located downtown Cleveland in the North Point building at 1001 Lakeside Avenue East, Suite 1520, or you can visit our website, cleconsultingfirm.com. We have enjoyed very much this experience, although we can't see you. And we hope to service some of you in the future. Thank you for your time and have a great, great day.
Hold on, Meltrice, we've got one question that came in.
Okay.
This will
Okay.
be our wrap-up question. Somebody
All
would
righty.
like to know if they want to invest in a company, what one financial statement would be critical to obtain?
I wouldn't even be a certified public accountant if I answered that question, because you cannot make a decision to invest in a company by looking at one financial statement. As we continue to emphasize throughout this session, is you have to look at the statements as a collective to get the real comprehensive understanding of the financial health of that business. So that's the profit and loss, that's the balance sheet, that is your cash flow statement, that's your ratios, that is also some of your supplemental statements that we didn't talk about, like your AR aging, your asset roll forward, your AP aging. So you want to look at that as a collective. Never, ever, ever make a decision to make any investment by looking at one statement.
Okay.
I would add to that is, even as you're evaluating those, I would say, like we've kind of also talked about throughout this conversation, is hire someone that is certified to do that, because you want to make sure that you're reviewing accurate statements. We talked about the inefficiency of, certain things being accounting for on a lot of financial statements based on the aptitude, or if someone has outsourced that service. So you just don't want to take financial statements and just say, okay, I believe them to be accurate, but you want someone to properly evaluate that if you're in a purchase mode. So that's very important.
And one other question that popped in, I'm sure you guys have answered this one a million times. How long should a company need to save their bookkeeping records?
So we say 7 years. The IRS retention is 3. But again, I take that back. I'd say 7. Just say 7. The technology that Maurice was mentioning, one technology that we use at our firm is called Dext. It's a receipt capturing system. It's actually a document capturing system, and they hold your documents for 7 years before they get rid of them, because I misspoke. The IRS retention rate is 7 years. So they hold it for 7 years, so you can recall it at any time for purposes of business valuation, or responding to an audit, or just recalling a document. 7 years is the standard.
And I would say physical documents, we always would say the current, of course, in the prior year on hand. If you have physical documents from a storage perspective, and then you can, send that out if you're not electronic, the prior documents, and store them. And any storage company you use from a document perspective, they're going to follow the IRS code as well, and then they'll discard those after it hits 7 years as well.
And then any contracts, you keep them the entire contract term. So if a contract is 10 years, you want to keep that contract. If it's 25 years, you want to keep that contract.
Thank you both for your time and your expertise in this area, and for staying over a few extra minutes to answer these questions.
Thank you for having us. It's been a great experience.
All right. Everybody have a great rest of your day. Take care.
All righty. Take care. Bye-bye.